Hello and welcome to Profiles in Risk. This is your host, Tony Cañas. And today I have with me Daniel Faggella, CEO and Head of Research at Emerj Artificial Intelligence Research. Daniel, thank you for joining me today.
Tony, thank you so much for having me. I'm glad to be here.
Awesome. And you are up in Boston area.
That's right.
Like. So we're recording on October 18th. So is Boston a frozen wasteland by now, or you still have
Not yet. I got another month before it's just all ice and sleet for 5 months. Yeah,
that is not too bad. Not too bad. Yep. Okay, so Daniel, we always give the chance to give the elevator pitch for your company.
Sure. Yeah. So Emerj Artificial Intelligence Research. You could think about us like a boutique Forrester or Gartner. We're kind of a publishing firm and a market research company. So we work with large enterprise companies in insurance, banking, and other areas of financial services to make high ROI AI decisions. Most companies don't want to invent the wheel as to how to set up chatbots or reduce risk or streamline the underwriting process. They want to figure out what the best of the best are doing. And we have the luck and the good fortune to be able to interview folks at the Geicos and the HSBCs and the Citibanks of the world to figure out what use cases are really working. So we support enterprises who want to make smarter decisions with their AI investments. That's our work here at Emerj.
So I think that you just earned yourself a few minutes of my most executive listeners actually listening.
All right.
Because I have had so many AI insurtechs. And I know that you guys are not just insurance, but we've had so many AI insurtechs that, and there's so many out there that it really has to, like, if I'm a technology buyer, it really has to make your head spin how many different suppliers there are. So the fact that you lead with the ROI, with helping you figure out the ROI, I think that by itself, that's a incredibly valuable service.
Big time. I mean, I think it's challenging as a buyer within a company, as someone in procurement, someone looking to solve a problem, to number one, kind of separate the hype from the real when it comes to the vendors out there. So who has real use cases that have actually delivered value, who doesn't really have those use cases yet, for whom are you going to be the guinea pig? As opposed to for whom are you going to be able to be more likely to get value? And then there's other deeper factors, such as what are the resource requirements that it would take to work with one vendor versus another? What's the kind of size and the footprint of the kind of impact we could expect by working with different vendors? That really does take a deep look under the hood. And frankly, it takes the ability to do primary research with the customers of these vendors to figure out the actual impact that they've had. And that's just not something that most procurement folks are ready to do.
No, even the CIO has to be intimidated by 1,700 options out there, right? And yeah, I'm very glad to not be in their shoes, right? Where you're deploying millions of dollars of capital, and God knows.
Exactly. Yeah. Yeah. The idea is if a company's making a decision that's going to start with, a $250,000, $350,000, $500,000 or larger investment, spending some tiny fraction of that on the kind of intelligence that would help them make a smart decision is often going to be a good move, particularly because these technologies can often start a roadmap of kind of where you're going to go. If we are, and this is in any company, in a retail firm, we start investing really thoroughly in recommendations and certain kinds of ways of portraying our products, that might start a bit of a snowball as the kind of investments we're going to make into the future. So to be able to make the right kind of choice around how our data infrastructure is going to be structured and the kind of capabilities that we want to build with AI it's consequential for sure.
Yeah. So how does your service work? And let's look at kind of a hypothetical case study, so to speak.
Sure. Yeah.
So let's say that I'm procurement or IT or the CIO or whatever at Westfield Insurance. So middle-sized, 175-year-old carrier, and the reason I use them is because I know them well, and they're going through this huge process to completely remake their small commercial area. So we're completely remaking our small commercial area. We would love to use some AI to make our underwriting a lot better as we rebuild this area anew. How do you work with us?
Yeah, well, generally speaking, it's unusual that we'll work with a firm. So we work with two kinds of companies. We work with the vendors and the service providers, and we do that by helping them introduce their narrative to the market, and potentially by bringing research insights into our publishing that will kind of get them into the mix. So, again, on our podcast, the AI and Business podcast, very, very popular show, 3 million plus downloads over the years. We'll be able to potentially feature them and or get them in the newsletter, conduct research that'll shine a light on things they're working on, et cetera. So there's the vendor side. If we're talking about the enterprise side, the user side, which is what you're bringing up here, generally it is companies with $1 or $2 billion plus in revenue. So it looks like the firm that you just mentioned is kind of at that lower bound, but that's perfectly fine. When we are engaged, it is normally because folks aren't just curious about what are we going to do with AI. They have an idea of a kind of impact they want to make. So an example was a company in Australia that we worked with not all that long ago, one of the largest insurance providers on that little continent out there, who is fully aware and already has a very strong roadmap and a lot of commitments in terms of budget and people to overhaul customer experience, particularly when it comes to chat and voice. So how people interact with the company for buying products, for customer service, et cetera. They know that needs to be transformed. And what they're looking for is realistic barometer of how much transformation they could see in that space over the course of the coming 2 to 3 years. So some vendor is going to tell you, oh, push this button and all your answers will be answered by chat, right? Of course, but that's ridiculous. What does this realistically look like for other financial services organizations? What are the actual capabilities of these vendors? What are the necessary requirements that we're going to have to be able to, let's say, get rid of those low-hanging fruit questions for customer service? What's my password? Basic things that get asked a bajillion times a day, what have you. So they have a direction, and now the question is, sort of how do we execute on this? What's the highest ROI to achieve the goal we're already committed to? That's normally when we get called in. Sometimes there's been a few instances where we need to find the best AI opportunity in this area of the business. So we had another big insurance company in the Sacramento area that was in the health insurance space and had a couple areas of the business where they're kind of saying, highlight what could be high ROI areas in these parts of the business. Far less usual for us. Mostly it's, here's what we want to do, but by golly, we don't have the best game plan. We don't know who the best vendor is. And we don't know what the best strategy is. Let's have somebody else do that homework. That's when we get called up.
Okay. So, and the homework that you bring back, you said a significant piece of that is based on primary research with actual clients of the firms that you're looking at?
Yeah. So the mix is basically the vendor ecosystems, the actual providers, and the users who've done business with that vendor ecosystem, or the users that have tried to build some of these things in houses. There are lessons to be learned from a company that's attempted to build out a chatbot or attempted to automate some of these things in-house if they have the resources, but it's particularly useful to get the ones that have actually interfaced with the vendor ecosystem.
This might be an oversimplification, but would it be fair to say that you act kind of as the Yelp for AI vendors?
It would be an oversimplification because I think with Yelp, you can just kind of have public facing reviews. Everybody knows who's got 5 stars. You go get Chinese food. In our instance, it's really personal and really tailored, customized to the individual client. So again, with the firm in Australia, it was, we have a certain kind of sets of chat and voice capabilities that we want to level up to a certain degree, and we want to know exact. And so one vendor that might be 5-star for this capability might be 2-star for another capability. They might be a great fit for a company of this size, but not as great of a fit for a company of this size. So there isn't really a single 1-star to 5-star, where do I eat my damn Chinese food way of doing this. It's, again, primary market research, interviewing individual companies from the user side and from the vendor side, and crafting every darn question around the specific circumstances of the client that we're doing our work for.
So it's very bespoke, very white glove.
Yeah.
So how long does it take? So the Australian company comes to you with that question.
3-month engagement is normal. Yeah. So we call it the AI opportunity landscape is kind of our umbrella term for most of this work, where we do the primary research with the vendor ecosystem and with the user ecosystem. 3 months from finally scoping what the deliverables are for the project. And the deliverables ultimately are going to be the data that is from the surveys and from the vendor information that we collect. It's going to be the analysis, that is to say the short report, generally no more than 12 pages, because by the way, nobody's going to read more than 10 probably anyway. And so it's very bullet point focused, very action oriented, very tight, intentionally written for an executive audience. Is not going to sit there and breeze through something that's 50 pages. And then advisory. And advisory might be 6 sessions of an hour after we deliver the piece. It might be something that stretches for a whole year, where we help kind of guide them through the actual delivery after.
Okay, so you really combine research with with opinion with advisory.
Advisory is part of the mix. Yep.
What to do.
Exactly. So we're not a consulting firm. We're not going to come in and help build your AI solution, but we do have, our strength is in the Rolodex. Our strength is hopping on the horn with the former head of AI at HSBC and grilling them with questions when we want to, or the former head of AI at, whatever, Comcast, or core machine learning at Facebook, or whatever. And so we'll do that hard work, collect that data, put together that analysis, and then we do provide some advisory. So we're not going to go in with wrenches and start to tweak up all your tech, but we're going to use what we're good at, which is the great connections and the ability to distill that for an executive audience, and then help you guide action in a way that's going to make this $500,000, $1 million project something that is high ROI, as opposed to, egg in the face.
Okay, makes perfect sense. And so you talked about how generally your client is $1 billion plus revenue.
$1 to $2 billion or bigger in revenue.
1 to 2 billion in revenue. Can you speak at all on how much it might cost to bring you in?
Yeah, sure.
I mean, spoke that it's hard to predict.
It is a little bit tough to predict, but I could tell you that most initial engagement. So if we're working with a company that knows us, trusts us, and we have kind of an ongoing relationship with, we might have larger projects that'll emerge from it. But generally speaking, an AI opportunity landscape engagement where some of the vendor ecosystem, some of the user ecosystem is going to be interviewed in a very direct, targeted way to put together a deliverable that's going to guide action, somewhere in the 40K to 90K range.
That's not bad at all when we're going to throw millions of dollars.
That's exactly it. Yeah, that's exactly it.
Yeah,
and so
that is not bad at all.
But even in that case, even with that band, which is not an outlandish, and again, we've done substantially larger projects, but for a first project, that's a normal engagement for us. Even with that band, which is relatively modest in terms of investment, I mean, firms pay ungodly sums to like a Gartner, for example. It is still firms at 1 or 2B in revenue that tend to work with market research firms in the first place, tend to have kind of the fluency of how to engage with and leverage the output of a market research firm. Also, it's only companies at those revenue ranges that often have the fortitude to actually adopt AI. Frankly, I mean, if you're an insurance firm founded 100 years ago, 170 years ago, and you've got 80 million in revenue, probably you have less than 0 data scientists. You know what I mean? Probably you have a very, very rough, kludgy digital infrastructure that really isn't the right soil to be growing AI in the first place. And so there's also an amount of digital maturity that comes with revenue that makes our kinds of service and our focus of greater relevance for firms in the $1 billion range.
Makes perfect sense. So just looking at some quick numbers on the Insurance Journal. So basically, anything bigger than the top 20 super regionals. So any of the national firms would be big enough. Any of the national P&C carriers. And this is really funny. So I used Westfield as an example. They're listed at 979 million a year. So very, very close to your.
That's funny.
I was so close.
Yeah. I mean, and again, it's not like that's a firm where we wouldn't even take the phone call, right?
Yeah, no. I completely get what you're saying. It's just funny how close I was to choosing.
Yeah, no, you're doing great. You're doing great.
Super regional.
You're right to say that. Same thing with banks. like a super regional bank might be a great match. A credit union in Wisconsin, probably not a great match. Again, they don't have the digital fluency, and they probably don't have the, the willingness to pull in a market research firm for help.
Completely makes sense. Yeah. Excellent. So you talked about the Australian company. Companies here in the States, even the P&C companies here in the States, even if you can't name them by name, I'd be very curious if you can share any examples of successful assignments and kind of what the end result was after what you suggested.
I mentioned that firm in Sacramento not all that long ago. This is a large company with many wings. One part of what they do is a very niche. I'll describe it. Would be the most accurate way of saying it would be like a very niche aspect of health insurance, where they are kind of farther ahead than most. In other words, they have a really good chunk of market share in a relatively niche domain of kind of benefits and insuring in one particular part of health. And so they were interested in where AI could be applied across this particular insurance practice. They already had a lot of ideas around white collar processes that they wanted to automate in terms of document search and discovery and things like that. And so that's where the bulk of their momentum lie. What we had put on their radar and what they began working with through some of our advisory was taking advantage of the fact that they actually have an inordinate percentage of market share in one part of one domain of health insurance. So this will bring us into a bit of an AI dynamic that maybe I'll explain, and then I'll talk about why this was valuable for them and kind of what they did with it. In the domain of artificial intelligence, there is a real benefit to being the one that gobbles up the preponderance of the data. So it's very hard to compete with Amazon, not simply because of how much money they have, but because every second a bajillion sales are made on Amazon, and that's informing their recommendation engines and their ability to provide a great user experience. They can recommend the best products by email, in your checkout flow, on your homepage, etc., because they know you as a user so well, because a billion other users, probably literally a billion other users just like you, are purchasing things just like you all the time. And so that's an example in a general market, e-commerce generally, which is a really hard market to fight in. In deeper niche markets, we might say, I don't know, motorcycle insurance in Canada or something. I'm giving you a random example here, by the way. If you have the preponderance of the data there in terms of the risk profiles of different kinds of buyers, who pays things back, who doesn't pay things back, all kinds of pricing information, etc., a huge percentage of the market share and a sense of its performance, you might be able to leverage that information to tighten up your recommendations and the way that you price your product and the way that you set your premiums and the way that you say yay or nay to certain people in certain markets that maybe other players wouldn't even be willing to extend their hand into, because they don't have enough data points with those age groups in those geo regions in order to even sell motorcycle insurance. So they're just going to take their hands away. But because you have more data there, you can actually selectively say yes and continue to win more and more market share. There's a real benefit to being to sort of owning the data in a particular space. And so for these folks, we had highly recommended that they think about improving data infrastructure in a way where they could start to collect and leverage more of the data in this little niche that they actually owned. And so our advisory with them was only 4 months or so, which certainly wasn't long enough to be able to see all of that through. But we at least got the momentum ball rolling on not just taking for granted the fact that we own this space, but by thinking about how we could tighten our hold there and expand that into other products in a bigger way. So that was one thing. And right off the bat, there were multiple vendor selections in the computer vision document scanning domain. So in paperwork heavy worlds, healthcare, financial services, so much of the kludge and ugliness of handling data is the fact that it comes in paper, it comes in PDFs, it comes in all these goofy formats instead of nice, clean digital formats that we can train algorithms off of, that we can search very easily. And so being able to, with computer vision, with OCR, optical character recognition, take in those data sources and digitize them. There were individual vendor recommendations there that were useful for them right away. So hopefully got some momentum rolling on an area of advantage. and then also help them, pick a path for an area they already wanted to go, but they didn't really know who was the best fit for them. So those are kind of areas of benefit where we might be able to support a company.
Makes absolutely perfect sense. And I had no idea this was an option, and super important for the buyers in my space who are overwhelmed by the sheer
A lot.
number of options, and in many cases, right, analysis paralysis, because it's not their world. And so yeah, let's talk about some of the use cases within insurance.
Great. Well, then there's so many areas within insurance as an industry where artificial intelligence is making its way. But what I will tell you is this: our estimate is that something like 60% or more of the actual investment being made in artificial intelligence solutions, and this is over the course of interviewing the users, interviewing literally dozens and dozens of vendors in this space, over 60% of the investment is being made in claims and underwriting combined, about 50-50 between the two. So let's call it 30%, 30% between the two, or more is being made in claims and underwriting. And so this is really interesting. I think people look at the press releases from the big insurance firms and they might think, oh, it's all in chatbots, it's all in cool customer facing applications, it's all in like some neat marketing or sales enablement stuff or customer service. But in fact, customer service, marketing, sales, altogether, we estimate that those are substantially under 25% of the total investment being made in AI in insurance, and that really 30% or more is being made in claims and 30% or more in underwriting. Again, those two combined, we estimate are safely over 60% of the use case impact of AI and the investments being made today.
Okay. Are there any, you mentioned while we were on break, so to speak, that there's significant differences between an AI project and an IT project. And I didn't know that. I would have thought of AI as just an IT project. How are they different?
Oh, there's oodles of them. And again, if you want to dive deeper into claims and underwriting for use cases, we can do that after the fact as well. I can walk through individual use cases of kind of where and how AI impacts current workflows in claims and underwriting. But
yes, please.
Sure. So we can get into that. But do you want me to dive into that first, or do you want?
Yes, dive into that first.
All right, let's do that first. Great. So for claims, in the world of claims, so AI operates very well where we have very predictable inputs and relatively predictable outputs. In the world of claims, we receive some sort of a claim that, hey, we need X amount of money because, X thing happened. And then we need to analyze that data and determine if we want to pay out this person or not. Obviously, claims fraud is a very big deal, but also being able to say yes when we're under obligation to do so is a big deal too. And there's a lot of potential for human error, but artificial intelligence kind of finds its fit by taking in the data sources of what these claims are. So the claim might be, okay, here was the date and time of this particular, let's use auto insurance here. Here was the date and time of this particular accident. Here's the kind of make and model of my vehicle. Here's the thing that I'm purporting actually happened. Here's what I'm suspecting that you actually need to pay me based on what happened. If we have a high enough volume of those kinds of claims, we can determine right off the bat which of them are more likely. So which of them are such a small deal or such a clear claim cause here that ultimately we're very likely to just have to pay this off. Maybe some of them are so small that require ridiculously small amounts of human intervention. Maybe some of them are going to involve still a lot of human assessment, but it seems quite likely that, yes, this is something we're going to pay. There's an entire ecosystem, though, of the various kinds of insurance fraud that occur in any given space in insurance. And where AI is mostly finding its way in are the spaces where volume is very, very high. So if you run an insurance company and you insure shipping ports, and there's only 8 such shipping ports of such a size and grandeur as to which you would sell your insurance products, it's very unlikely that AI is going to work out there. But if you do auto insurance, or you do maybe some kind of home insurance or something like that, these are very high volume insurance domains. And so if we take in data we may be able to determine, hey, this kind of a claim, potentially even made by this kind of a customer, has a 2 to 4x likelihood of being fraudulent compared to, let's say, most claims of a similar kind, just based on these surrounding factors. Let's go ahead and flag this for more scrutiny than, let's say, would be usual. So instead of having a system where we have a lot of humans with halfway decent intuition, we can scale that intuition to ground it in real data. We can ground it in all the instances of fraud that we've ever had. And we can ask the question of the data, do you look similar to fraud? Or we can ask the question of the data, do you look vastly different from an average claim of this kind? And if something is vastly divergent from the norm, or something matches in remarkable detail the kinds of data footprint of previous fraud, then we can allocate our human kind of assessors of risk to be placed in places where they're most likely going to unearth that. So instead of randomly screening things or relying on individual intuition, we can coax out much more fraud and catch much more of this by flagging and tagging systems based on the volume of data we've already collected. Let me know where you want to go into here. This is kind of a lot to drink in, but it is a really important use case. So I'd like to make sure people can understand it.
I was curious on how do you handle the black box? So, right, we're a heavily regulated industry.
Oh, yeah.
And I don't speak AI, but my understanding is that the deeper we get into the AI, the more likely that we are to see results that we can't necessarily explain, right? The system found the correlation, but can we explain the correlation to the regulator?
Yeah, well, I think here's the important shebang. So there's two elements to this. One is there are methods of improving the transparency of AI systems. The examples that we're talking about here are actually somewhat discrete kinds of data. So we have the make and model of the car. We have the date and time of the accident. We have, the demographics of the customer. We have, the geo region where it actually occurred. We have the class of accident, whatever. These are all discrete fields. And so it would hypothetically be possible for us to have a machine to say, hey, the time and date of the accident and the nature of the accident seemed very divergent from our past history of similar accidents. And so that's why this is being flagged. So because we're dealing with relatively discrete fields, transparency isn't an unbearably complicated problem here. I'm not saying that there's no such problems, but I'm saying it's not as complex as it might be for other kinds of use cases. Second, we don't need the machine to actually determine if we're going to pay this person or not. In fact, that's almost never going to happen. What we need the machine to do is to flag and tag things so that we can use our limited human resources in more intelligent ways. Instead of randomly assessing in a deeper way every 20th claim that comes through or 200th claim that comes through, we can focus in on those which the algorithm maybe deems may have higher risk. So there's no point where we can say, the evil machine made me pay, or the evil machine said I couldn't pay. No, we're just using correlation and we're helping human beings be more effective at what they're doing. And so in that sense, the punishability of the dark machine is not so much of a mystical and terrible thing.
I've worked at a few different insurance companies, and I spent only a couple of years in claims. But I really hope that nobody in 2021 is deciding which claims to dig deeper into based on claim number 20 or based on a run.
Yeah, sure. No, exactly. I mean, they might have some. They have some statistical way of doing it already. They have a set of rules, right? So the way that this works, I could talk about a dozen use cases outside of insurance that are essentially this same damn workflow. So one of these could be payment fraud. In the domain of payment fraud, American Express doesn't randomly investigate 1 in every 20. They have a bunch of structured rules and kind of if-then scenarios that kind of help them determine which ones to sniff around on and which ones don't. But a company like Amex, and again, we've interviewed their head of ML research, even a company like Amex is leveling up the ability of AI to fill in those gaps between the rule sets, because this is a domain that's constantly in flux. There's no one simple way where we set a hard statistical model and, okay, this is the permanent best way to detect fraud. People are coming up with new ways to defraud people all the time. All the time. In fact, very smart people are coming up with ways to come up with insurance fraud. So it's what we would refer to as an adversarial circumstance. And so we need to play in between if then rules and constantly coax out new patterns. And so the exaggerated example of digging into 1 out of every 20, it ain't working like that at Amex, and it ain't working like that at Geico. But you understand what I mean. It's some rule of thumb that they're using. Maybe it's a sophisticated rule of thumb, but it's not quite as granular as AI that's picking up on data line by data line precisely what might match a pattern of fraud.
What about on the underwriting side? What kind of use cases are you seeing? Is it mostly, no, you know what, I'll leave it open-ended.
Sure. So on underwriting, again, we're looking at high volume domains. So if you underwrite, 5 super yachts a year, you're not using AI. But if you underwrite a bajillion instances of car insurance or home insurance or motorcycle insurance or whatever, then you may leverage it. So again, we're looking at big volume domains when we talk about underwriting. There's the way that underwriting AI is being thought about by the Geicos and the Allstates of the world today. And there's the way that I believe they will think about them in the future. And frankly, they should be thinking about them now. So I'll talk about both for you. The way that they're currently thinking about it is essentially improving efficiency. And so saying no to more of the kind of people we should say no to when it comes to underwriting, or setting terms in a way that accounts for risk in sort of the right balance. So hoping that we can deny folks if we need to deny them, or we can set the terms that are going to be the most profitable given the amount of risk this person actually is likely to incur for us. And then roll those out. So being able to kind of just tighten up our margins and be able to say no to the right kind of stuff and say yes to the right kind of stuff is how these companies are thinking about it. And again, it's based on past data volume. So we can look at a bajillion instances of insuring cars to 25-year-old males, or let's call it pickup trucks to 25-year-old males. And we can look at what are the circumstances where this kind of pricing was good for us, this kind of pricing was bad for us? What are the likelihoods that this kind of a premium and this kind of a plan will actually be productive or not? What are the factors that should flat out make us just say no to this entire kind of customer? Being able to tighten that up, again, we talked about it, rules of thumb, perfectly fine. The industry can run on rules of thumb, but ML helps to fill in those gaps. A deeper, tighter detail on who to say yes or no to, a deeper, tighter detail into how to calibrate our pricing. That's essentially how firms are thinking about this today. Now, into the future, they should be thinking about underwriting not as a margin game, kind of winning our margin, tweaking our margins, but as a market share game. So, and there's some startups working on this already, but at the end of the day, artificial intelligence is going to allow us to proxy the level of risk of a potential insurance customer from data that is maybe not traditional. So in the world of lending, so I'm going to take you out of insurance and into banking for half a second, but it's an analogy that's going to carry us back to insurance. So bear with me. In the world of lending, there are thin file accounts. So if I want to give you a loan, I kind of want to see how you've handled money in the past. But with a bank, I want to see very specific things. I want to know about the past loans you've taken out. I want to know about your bank balances. I want to know about whatever credit card activity, whatever it is that I need in order to say yay or nay to some kind of a personal loan. There are folks like millennials, or there are folks like people in the developing world, or folks that have kind of maybe lived in much more rural areas and haven't used traditional financial instruments in some way, shape, or form, who maybe are thin files. They don't have the kind of robust information we would normally use to say yes or no to a loan. And so we kind of carve them out. That's not a world where we do business. But the fact of the matter is, most of the products that could be sold in the next 100 years of lending or 100 years of insurance are going to be for things that maybe we don't have a default way of determining and collecting data for. So there's a lot more yeses, a lot more happy, profitable yeses for some of those thin files for new kinds of products where, yes, we don't have the perfect FICO set of data we normally use for this. But if we can proxy off of data source X, Y, and Z, we can get ourselves enough of a rule of thumb to start saying yes to a whole new slice of pie that we weren't saying yes to in the past. So for both lending and for underwriting, what we call the offense side of lending and underwriting, I think will really be the future. Right now, most of them are just thinking about reducing risk and margin, which is much more defense. Let me know if this is making sense.
Are there any carriers that have kind of made the move to the more offensive side? So I don't know, like the Progressive, or is everybody still playing defense in PNC in the US?
I don't know of any strong instances of firms actively leaning into offense right now in either banking or insurance. That could be a fun research project for us. I'm sure that there's some companies that maybe have made some moves, but to be frank, what I could tell you for sure is, number one, I don't have any individual instances offhand for you. Number two, it is absolutely clear, and I would bet every dime to my name, that the vast preponderance of all investment in underwriting is being made in this risk and kind of margin tightening mindset, as opposed to this winning new slices of pie mindset. So there might be some, but they would be relatively few and far between. I know there are some startups, none come to mind, but I know there are startups in both lending and underwriting that are thinking about this. But the bigger companies, as far as I know, are not.
Well, when you're an incumbent, right?
Okay.
It's hard to get out of your own way.
It is,
and it becomes easier to protect your balance sheet than to take big swings for the fences, right?
Yes.
While the startups, especially if they're playing with venture money, can take swings for the fences.
Yep.
They have nothing to lose, right?
You're right. You're absolutely
right. A lot to gain and nothing to lose.
Yep, you're totally right. There's different incentives for different kinds of companies. So I'm not necessarily blaming the big guys. I'm just saying that at some point they will lean into offense as well, and I think it'll be natural and at some point absolutely quite necessary.
So are you willing to make a prediction? Are we talking 2025, 2030?
Honestly, so I have a little bit more experience in banking here, so I'll try to see how I want to carry over my banking prognostications into insurance. And prognostications of any kind are very dangerous things to have.
Yes,
yeah, I don't pretend to have any crystal ball, but what I will tell you is that our estimates are that in the world of banking, it's likely going to be another half a decade until offense as a mindset around AI becomes normal in any line of business. Never mind in the world of lending. So if I was going to give you a rule of thumb as to when, let's say, so if you were to say, hey Dan, when will most of like the big 5, big 10 US insurance companies have some portion of their underwriting activity actually focused on busting into new markets and winning new market share, I would be surprised if it was any earlier than 5 or 6 years from now. I think it's going to be a minute. There's so much to be done about getting used to AI as a technology that there's a lot more work to be done there in terms of just getting our bearings with leveraging and unlocking the value of data, never mind thinking about new ways to develop a product and serve customers or new ways to consider our operations altogether. Those transformative things, I think, have a while to wait.
And yeah, insurance tends to go 5-10 years after banking. We tend to be particularly slow.
Well, now, if that remains the case, then maybe we're talking about a decade. For some reason, I don't suspect it'll be a full-blown decade, but it is hypothetically possible that would be the case. If there's enough startups winning enough money, I think the big guys are going to have to move. But yeah, that would be it. Again, I have prognostications in banking. It's very dangerous to transmit them, but you wanted my gut instinct.
The good news.
There it is for you.
The good news for any listener, that means you are not too far behind, right? It's not like telematics, what Progressive's been doing it for 20 years.
Yep.
You're not too far behind. You could be a leader if you had the spine to jump in and start experimenting with it. Your company could leapfrog. So of course that is very uninsurance-like to try.
Yeah, it's extremely uninsurance.
Extremely uninsurance-like, but if there's a young executive out there who wants to make a name for themselves and they're willing to gamble, this could be an interesting way to do it.
Take a stab at it. Yeah. So yeah, I think if you just you read the Twitter feed or you look at all the kind of hypey press releases, you're going to feel like you're astronomically far behind with AI adoption. But the fact of the matter is, we're really only at the tip of the iceberg, even with the big boys. So you're absolutely right to tell your listeners that it's mostly green field out here. That's for sure.
That is really good to know.
Yeah.
That is really, 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 really good to know. So that means that InsurTech Connect will continue being an interesting conference for many years to come, which is good because I have a lot of fun.
Okay.
For the listeners, if you are on the technology buying side of an insurance company and you're not going to ITC, you have to. It really is pretty incredible. So anything else that I should not let you go without asking?
Oh man, you mentioned briefly the difference between IT and AI. We have an article on this. If you type into Google EMERJ, the difference between IT and AI, just after the word EMERJ space, you'll find a much more robust infographic that makes it simple. It's just a simple table about the differences in predicting ROI, the differences in time to ROI, and how team collaboration works. There's a lot to dive into there, but it is important for your listeners to know, and I'll make this very brief, like a minute or two, that the adoption of artificial intelligence is much more like R&D than it is like IT. It's much less like, let's plug in the system and bada bing, next week we're going to have some new functionality. And it's much more like sinking our fingers into our own data and into our own workflows and experimenting to see if we can coax out some additional value by training an algorithm on these features or these features. Even very simple workflows really have a very experimental nature to them. And so vendors are going to sell this like it's IT, as if it's going to be plug and play. But the nature of AI, and it can be a good or a bad thing, is that it's much more like R&D than it is like IT. And so folks that go in thinking it's going to be push button are in for a rude awakening. Folks who go in expecting they're going to have to learn a lot about their data, they're going to have to learn a lot about how their teams collaborate, that they're going to potentially need to have more in-house talent around data science, folks that know that they're going to need to grow culturally and that this is going to be an experiment, are in a better position to turn an AI project into actual value. But if you go in under the assumption it's going to be like MailChimp, you sign up for an account, you start sending emails, the rude awakenings there are absolutely atrocious. So it's important to know the difference.
Does it tend to have an exponential type curve where for a long time it looks like very little changes happening and then all of a sudden it hits that hockey stick, or no, it truly is experimental, it might not go anywhere?
Well, look, I mean, I think there are some very big potential upsides to leveraging AI. I mean, there are some projects that really could be huge differences to the bottom line for certain companies, whether it's reducing fraud, whether it's improving customer service. I mean, there might be some hockey stick like impacts in terms of efficiencies or revenue or whatnot. But what I will say is this: we think about ROI in a very particular way based on a lot of interviews with enterprise companies. And we have a model that kind of references measurable ROI, strategic ROI, and capability ROI. If you type in the 3 kinds of AI ROI into Google, you'll find our more robust infographic on that. But the idea of capability ROI is one that I want to stick to based on what you just asked me. This is the idea that part of the value of getting involved in an AI project is learning about our core data infrastructure, learning about how to unlock the value of our data, because all of this is new. It's a new, very different way of doing and thinking. It's a new, very different way of interacting with our data and influencing our workflows. And just the nature of the work the ability for us to learn, the ability for us to improve our data infrastructure, to improve the way our teams are structured so that we can collaborate on these AI projects, the ability to learn and build new capabilities. Whether this particular project works out or not, if we're not of the belief that learning is of value unto itself, it's very unlikely that we'll ever see those hockey sticks. So the tough part about AI is that a lot of our early projects are often going to be, the main ROI will be what we've learned about what didn't work, what we've learned about the limitations of our data or the opportunities of our data, what we've learned about the talent requirements that we have in-house. These are all things we want to learn. And if we're treating them like projects where we put in our coins and this project works out or not, and if it doesn't work out, we're sad forever, that's not really the right mentality. The right mentality with AI is more of a portfolio approach where we're building a new set of capabilities, and really only with a new foundation of what we call AI maturity. And again, you can Google Emerj, AI maturity, and find our infographic and our model for that. If we're not building AI maturity, we're very unlikely to see hockey sticks altogether. So are the hockey sticks there? You damn well better believe they are. Are we likely to build them if we treat this stuff like it's plug and play? And if we treat it like we don't have anything to learn? Absolutely not. Enterprise companies have an unbelievable amount to learn.
So IT transformations in general are a marathon, not a sprint. Sounds like AI is an Ironman.
That's great. Oh man, I might quote you on that one,
no
Tony.
problem. Absolutely.
That's really good. That's really good. IT transformations are a marathon, not a sprint. AI is an Ironman. I mean, man, why don't you do I gotta have you write an article. That's a good one. I like it. I like it. And you're absolutely right, Tony. You're absolutely
right. So if I'm looking, right, if I'm Nationwide Insurance or whoever, one of the big guys, State Farm, Nationwide, whatever, does it make sense to experiment with AI first in the areas that I'm really good at, or in the areas that I'm struggling with?
Oh man, I have so many. I mean, I spent such a huge preponderance of my life developing very specific answers to this, ways of thinking about this problem. So how do we select first AI projects? So much to go into here. It's unbearable how much I want to say, but don't have the time for. What I will say is this: the right way to think about AI projects in terms of picking first projects, and again, infographics galore on this topic, but I can't keep referencing one every time you ask me a question. The right way to think about AI projects is to find something where we believe, and there's way more than this, but I'm going to give you the tightest nutshell without losing all of the essence would be the following two things. We want to be able to find a project that has the potential for a near-term win. So whether it's reducing risk or automating process, we want to be able to see a measurable impact. So we want to have something that is proximal enough to be able to see some kind of a near-term win, but also is part of a broader capability that we might expand that will help us reach our digital transformation vision, help us reach our long-term 5-10-year goals as a company in terms of market share or whatever. So as an example, I'll leave insurance, we'll go to like retail. We might think about, in order for us to compete, let's say we're Target, we've got to have loyalty and repeat customer like interactions dialed in so that we have any chance against Amazon, because people are going to push a button, blah, blah, blah. We have to have a tighter relationship. We have to have better loyalty. So we could get involved in a project that might have to do with product recommendations on site or via email, or get involved in a program that involves some kind of reward program for when people visit our physical stores. We could do something small where we could measure greater visitorship to our stores and cart value and things like that. But we'd want to do that in line to what that could become longer term, which might be about some more deep integrated online and offline way of consistently fulfilling our customers' basic needs. So they don't push the one-click button on Amazon to get their toilet paper. They still come to us to get it. So we'd want to have an eye to the longer term transformation. The reason this is critical is because a lot of short projects, that nice little low-hanging fruit win we want to get is hard. It's hard to do. Our data infrastructure is tough. We don't know what features to train on. It takes longer than we expect. And we're not going to fight through that muck. We're not going to make it to the other side and see that near-term ROI unless we know that it is part of something bigger and better that's going to help us achieve our longer term objectives. So if you have both of those with your early AI project, We have a near-term measurable win that we believe is genuinely accessible, and it is heading towards a broader capability that we're committed to as a company. If you have both of those, you are doing better than 70% of arbitrarily selected enterprise AI projects.
Okay.
So just by doing those two things.
Who is the large person in the organization to lead lead the efforts? Is it the CIO, or is there such a thing as a chief AI officer?
Sure, there is chief data officer, things like that.
Okay, the chief data officer generally.
Chief data officer. Yeah. There are some, I mean, I don't know of any insurance folks that have this per se. Head of AI is a common title. VP of AI, things like that. What did you say?
Not within insurance yet.
I would actually suspect that I could get some heads of AI at maybe like a Geico or an Allstate, but I could be wrong about that. Certainly in the banking world, they're there. And certainly at like a VP level, in terms of high level data scientists, there's plenty of them in the very, very big US insurance companies. But generally, the rule of thumb here is that the commitment to transformative change and the willingness to bend culture towards experimentation really has to start at the top. I can't tell you how many times we've learned this lesson. I wish I could say the little enthusiastic feller could get the job done. No. Look, the little enthusiastic feller can help improve the AI fluency of his or her peers, of maybe some of the leadership that's around them, but ultimately broader transformation really has to start higher rather than lower. And we're very far from a future where the future I hope we can arrive at, and that I'm trying to push into reality as much as I can with my little role here as a market research firm, is a future where high-level enterprise leadership understands AI conceptually and sees how it fits into their strategic goals. So they can look down at projects and say yay or nay, not just based on how much money is that going to make me in 3 months, or some little near-term thing. They understand its transformative potential. They understand how it ties to the longer-term strategic goals of the company, and they can, from an executive seat, understand and allocate those R&D budgets in appropriate ways because they grasp the technology conceptually and they see where it fits in strategically. We are half a decade from that in banking, so you tell me how long that's going to be in insurance. It's going to be a long time. It's going to be a long time. So yeah, the higher we can go, the better, but right now, it's more people at the head of director level who get it and who are fighting with all their might to make these first projects happen. And those are the real champions and people we end up supporting.
So what's the best way to connect with you guys, to start the conversation? Is it going to emerja.com and just filling out the form, or what's the best way to reach out?
Yeah, I mean, folks who are interested in our work will often just sign up for the newsletter and learn about what's going on with AI in their space. So we have a whole PDF guide called kind of the executive brief for AI and insurance at emerj.com/INS1. That's INS like insurance and then the number 1. So emerj.com/INS1 is an easy PDF brief and people can read the newsletter. But if they want to reach us, they can just go to the emerj.com/contact and be in touch and learn a bit more about what we do for our services. But we're on Twitter, we're on LinkedIn. Some people just follow the threads there as well.
Fantastic. Thank you very much for your time. It's been a really fun one, and I'll include links to your podcast and the website cool. When this goes live. And hey, listeners, if you do end up engaging them and it leads you down a cool path, I'd love to have you on to talk about how the AI tool that's actually paying off, that has actual ROI. So
yes,
reach out, next year or after it's implemented, because we don't have nearly enough people from the carrier side coming to on the podcast, and I'd love to have you. So Daniel, thank you so much for your time. It was a lot of fun.
Awesome. Thanks, Tony. I appreciate you having me on.